This LOS is describe the construction of different types of technical analysis charts and interpret them. Technical analysis tools. Now we're going to look at charts, and the first chart we're going to look at is the line chart. Line charts are familiar to all types of analysts and are a simple graphic display of price trends over time. Usually the chart is a plot of data points such as share price with a line connecting these points. Line charts are typically drawn with closing prices as the data points. So here you can see in this example I've got the S&P 500, which is not a share but it's an index, and we're showing the index level from 1970 all the way to, in this case, it was January 2, 2014. Okay? The second type of chart is the bar chart. And on the bar chart, it's going to show the opening. There's four points of information that are given. The opening price, the high, the low, and the close. Okay? In this case, you can see the closing price was higher than the open price. The next type of chart we're going to look at is the candlestick chart. And the candlestick chart also shows four data points: the opening, the high, the low, and the close. But the difference with the candlestick chart is that they have a body to the chart. And in this case, the white body means the market closed up. So you can see here the close is higher than the opening price. And in the candlestick chart that is shaded, that is dark, you can see that also have the same four data points: the opening, high, low, and the close. But the close is lower than the opening price, so the market closed down. And so that's basically the small difference between the bar chart and the candlestick chart. Same four data points, but with the candlestick chart, it's either the body is not shaded, it's white body, or it's shaded dark. With the white body, the close is higher than the open, closed up, and the dark body means it closed down, the close is lower than the open. Continuing with the technical analysis tools, we're going to look at more charts. The next one is the point and figure chart. Point and figure charts were widely used in the United States in the early 1900s and were favored because they were easy to create and update manually in the era before computers. As with any technical analysis tool, these charts can be used with equities, fixed income securities, commodities, or foreign exchange. Point and figure charts are particularly useful for making trading decisions because they clearly illustrate price levels that may signal the end of a decline or advance. They also clearly show price levels at which a security may frequently trade. In using the point size and reversal size to make trading decisions for uptrends or columns of X's, the practitioner would maintain long positions. The reversal size could be considered the amount of loss that would prompt the closing of a long position and the establishment of a new short position. The larger the reversal size, the fewer columns in the chart, and the longer uptrends and downtrends will run. Okay, we're just going to look quickly at the exhibit from the text. This is with regards to a point and figure chart, Wharf Holdings. So two things about the point and figure chart. Clearly you can see the price on the y-axis and time on the x-axis. You can clearly see that the price levels at which a security may frequently trade. That's the first thing that you can quickly see. And then the X's are uptrends. That's when the security is moving up. And the circles are the downtrends. And so trading decisions can be made, for example, if after a certain number of circles, it would be a sell signal, or after a certain number of X's up, the uptrend would be a buy signal. The next type of chart to look at is the scale chart. And for any chart, line, bar, or candlestick, the vertical axis can be constructed with either a linear scale, also known as an arithmetic scale, or a logarithmic scale, depending on how you want to view the data. With a logarithmic scale, equal vertical distances on the chart correspond to an equal percentage change. A logarithmic scale is appropriate when the data move through a range of values representing several orders of magnitude. For example, from 10 to 10,000. A linear scale is better suited for narrow ranges, for example, prices from $35 to $50. The share price history of a particular company, for instance, is usually best suited to a linear scale because the data range is narrow. So just very quickly capturing from the text, you can see the exhibit was the Dow Jones Industrial Average on a linear scale from 1928 to 2010. So you can see this is a linear scale is what we're often familiar with regards to security indexes over a long period of time or with individual security prices. And if I just scroll down, they're going to have the same data but on a logarithmic scale. So here we are, the Dow Jones Industrial Average on a logarithmic scale. You can see it's much flatter. And finally, the last chart we'll look at is the volume chart. Volume is used to assess the strength or conviction of buyers and sellers in determining a security's price. For example, on a daily price chart, below the price section would be a column chart showing the volume traded for that day. Some technicians consider volume information to be crucial. If volume increases during a time frame in which price is also increasing, that combination is considered positive, and the two indicators are said to confirm each other. The signal that would be interpreted to mean that over time, more and more investors are buying the financial instrument, and they're doing so at higher and higher prices. This pattern is considered a positive technical development. Conversely, if volume and price diverge, for example, if a stock price rises while its volume declines, the implication is that fewer and fewer market participants are willing to buy that stock at the new price. If this trend in volume continues, the price rally will soon end because demand for the security at higher prices will cease. So we'll just do a couple of practice questions to finish this LOS. The first one, a daily bar chart provides A, a logarithmically scaled horizontal axis, B, a horizontal axis that represents changes in price, or C, high and low prices during the day and the day's opening and closing prices. I think that question was pretty easy. C is correct. The top and bottom of the bars indicate highs and lows for the day. The line on the left indicates the opening price, and the line on the right indicates the closing price. So a daily bar chart has 4 data points: the opening, high, low, and the close. And of course, the horizontal axis is time, and so the A and B are clearly wrong. Another quick practice question. A candlestick chart is similar to a bar chart, except that the candlestick chart A represents upward movements in prices with X's. B also graphically shows the range of the period's highs and lows. Or C has a body that is light or dark, depending on whether the security closed higher or lower than its open. Well, I think that question was pretty easy as well. You'd be happy to see that on the exam. A candlestick chart is similar to a bar chart, except that the candlestick chart C has a body that is light or dark, depending on whether the security closed higher or lower than its open. So C is correct. Dark and light shading is a unique feature of candlestick charts, and I just copy and paste the picture from the previous slide showing on the left. The white body means the market closed up, the close is higher than the open, and the shaded or dark body means the market closed down, the close was less or lower than the open. In analyzing a price chart, high or increasing volume most likely indicates which of the following: A, predicts a reversal in the price trend, B, predicts that a trendless period will follow, or C, confirms a rising or declining trend in prices. Okay, C is correct. Rising volume shows conviction by many market participants, which is likely to lead to a continuation of the trend. So in analyzing a price chart, higher increasing volume confirms a rising or declining trend in prices. Momentum. And one last practice question to finish this LOS. In constructing a chart using a logarithmic scale on the vertical axis is likely to be most useful for which of the following applications? A, the price of gold for the past 100 years, B, the share price of a company over the past month, or C, yields on a 10-year treasury for the past 5 years. And the correct answer for that is A, the price of gold in nominal dollars was several orders of magnitude cheaper 100 years ago than it is today, roughly US dollars, US 20 then versus 1100 today. Such a wide range of prices lends itself well to being graphically displayed on a logarithmic scale. And that's the last slide for this LOS. Thank you.